Hello Forex traders, welcome once again to this channel. Today we're going to be analyzing GBPNZD. Now GBPNZD, I can see a very nice setup on its sell buyers. Now I'm going to be breaking down what is my thought process towards this pair and why am I thinking of selling it. So if you have been with me for a long time now, you realize that I'm a top-down analyst and I go from the higher time frame and I break down my trade from the higher time frame, such as the monthly, weekly, daily, and 4 hours. I am also a swing slash intraday trader. I trade day trade and I also hold trade for weeks, sometimes a week, sometimes 2 weeks. Highest I've hold trade for is for 2 weeks. Now, if you are new in this channel, please make sure to click that bell icon. Make sure to subscribe. You click the bell icon so that you'll be notified anytime I send a video. You'll be among those to be notified. So therefore, let's go and start breaking down this chart from the monthly time frame. So this is the monthly time frame. Now on the monthly time frame, what can we see? We could see the monthly time frame here on the monthly time frame. This is what we do on the monthly time frame. The monthly time frame, only what we do on the monthly time frame is to identify the directional bias. Now we come to this direction, this time frame to check where the market is going to, so that we can be able to forecast where next to trade, because it is only a blind man that goes to a particular place without knowing where he wants to go. You understand what I'm trying to say? So now you can see that the market has been creating series of higher highs, higher lows, 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 higher highs. Now it has come back and broken out this structure. It broke out this low and also broke out this trend line. So this is two things. This two confluence showing the market has changed direction. It broke out this low pulled back down, went back up, and also broke out. So it broke out trend line and also broke out structure. So this market is what? Bearish. Now, not just that, on the monthly time frame also we check for candlestick formation. You will see that only just bearish candle engulfed 4 good monthly time frame candles, 1, 2, and 3. Now the market came back, retested back the trend line, and what are you seeing? The market is going to drop back to this point, because this point here is a point that had like a spike. Market came to this place, pulled it back, went back up, this place held it, pull back, this thing held it. Now the market started rallying back up. So we'll be expecting market to drop to two places: one, the neckline; two, this point here. So this is it. Now we have identified the directional bias by just looking at the structure of this time frame. Are you understanding? Now, using a line chart, you could see that the market has been creating series of higher highs and higher lows. Just to be clear, you can see higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, higher highs, higher lows. Not just that, it also broke out this line, retested it again, went back up. For you to see that this line is the high probable line. Now went back up, created there lower low and lower high and higher low, higher highs, higher lows, higher highs, higher lows, higher high. Market broke out from this structure, broke out from what? The trend line, also retesting back, has not also retesting, has retested back to the trend line. Now I'm coming back to this point here. Now that is it to the week, to the monthly time frame. Now we have found the directional bias of this time frame. Now this time frame now is bearish. So anything we're going to be thinking about is what? To sell this pair. To sell this pair. I repeat again, the monthly time frame is to find the directional bias. Are you getting? Now we're going to be going down to the weekly time frame. If you're asking yourself, which time frame do I use to trade? Starting from, I start from the monthly time frame, weekly time frame, daily time frame, and 4-hour time frame. These are the time frames that I use for my entry. Because sometimes I may likely play with the 15-minute or 30-minute time frame. That is if I'm seeing a confluence, but it's most of the time. It's very rare before I go to that time frame, and I have good reasons why I go to that time frame. Because I don't go to that time frame because that time frame are very high. They are prone to manipulation a lot. So I have to see many confluence and a lot of things before I will go to that time frame to execute. So that is it. Now we're going to be going to the weekly time frame. The weekly time frame Now we are in the weekly time frame. Now on this weekly time frame, the use of this weekly time frame is to check for space in which we can trade to. Check for if there's any obstacle that may likely stop this thing from going to the direction where we are anticipating this market will go, and check if there's any other chart pattern that may likely push this into that direction, or chart pattern that may likely stop it from going to the direction. Now we could see that there's one chart pattern here, this left shoulder, head, right shoulder, in which has formed but has not yet been valid because the neckline has not been broken. This is the neckline. This line here is the neckline. This is left shoulder, head, right shoulder. Now, what am I anticipating on this? I'm anticipating this to pull back down to this place. I'm anticipating a pullback down to this point here. Now, that's what I'm anticipating market should do. You understand? But first of all, you know the market has to create some series of lower lows, lower highs, lower lows, lower highs. Now, since we have anticipated the directional bias of this pair, in which it is bearish, and we have anticipated a head and shoulder, in which if I'm to use my pattern tool and head and shoulder, you realize that this is the left shoulder, this is the neckline of the left shoulder, this is the head, this is the neckline of the right shoulder, and this is the right shoulder. Voila, we're waiting for a break now of the neckline. So this is a head and shoulder pattern being formed on the weekly time frame. Now anytime we see chart pattern on the weekly time frame, such as double bottom, double top, this chart pattern has taken a lot of time. Like it has been accumulated, like a whole week, one candle to form, just 1 week for a candle to form. And do you know how many weeks that made up this chart pattern to form? So if the neckline should break and it retest, it must surely go to our direction. So it is a chart pattern on the monthly time frame or the weekly time frame is well respected compared to lower time frame chart patterns. Now, since we have seen this, what are we going to be anticipating? We are going to be anticipating, we have already anticipated a pullback to this downside, but how are we going to be taking advantage of this? Now, how are we going to be taking advantage of this? This is where the daily time frame comes in play. Where all this time frame must be in sync. All of them must be correlated. If the monthly time frame is bearish, the weekly time frame must be bearish, and the daily time frame must also be bearish in order for us to take advantage of it. If the monthly and weekly are, or the I prefer when the monthly and daily are in sync. You understand? If the monthly is bearish, then the weekly may likely be bearish because weekly sometimes usually respect the monthly time frame. There's no that much difference in it. You understand? But the daily time frame usually have its own mind of its own self. The monthly and weekly may be bearish, but the daily may be contradicting, just like what you see just now. You are seeing now that this time frame is currently bearish. The monthly is bearish, the weekly is bearish. Now we're going to be going to the daily time frame to see how we're going to be taking advantage of this. Now this is the daily time frame. Now what can we see on the daily time frame? Market was also creating series of same thing. Now you see market was creating lower lows, lower highs, lower lows, lower highs, lower lows, lower highs, lower lows, lower highs, lower low. Now we're expecting, now you can see now the monthly time frame, weekly time frame, and daily time frame are in sync. So we're going to be expecting a pullback to this resistance zone before a sell. Now, before market may likely break the neckline of the head and shoulder. So we are going to be catching this pullback to this place, down to this place. So we are going to be likely holding our trade from here to this point, but we are going to be taking partials. When market reach here, we are going to take partials. Then this is going to be our overall take profit. So how are we going to be taking advantage of this now? Now, as I said earlier, we're going to be waiting for a pullback to that point here, to this point here. So if you realize, I like using Fibonacci mostly on the daily time frame or weekly, depending on what I'm seeing and how it's giving me the vibe, but I almost always like using Fibonacci. Now, Fibonacci, the 50 fib retracement level and the 60 fib retracement level are the golden ratio. What did I say? They are the golden ratio that identifies that whenever they correspond with a support or resistance zone, that zone is market will always respect that zone. You understand? And there are points. I will not give out all my explanation here. So if you like the way I cheat or how I explain things, please make sure you DM me or comment on the comment section there. I will respond to you. That is it. Or check on my description there. You will see my Telegram channel. You can also join. And I'll also teach you there. I can also teach you, or you message me, I'll respond to you. Now, back to this. Now, for you to see that this resistance zone there is high probable, it's a highly probable resistance zone in which I'm going to be looking for is selling opportunities from that resistance zone. A selling opportunity from this resistance zone. Now, let's see if you check very well, this resistance zone also corresponds together with a psychology level. Can you see a psychology level? Look at it at this point here. You see it 2.28000. That is a psychology level. So in which it intersected, that Fibonacci also intersected there. So that point there is a highly probable place. Now, if we also if we also should use our EMA, exponential moving average 50. At that point there, if it should correspond at that resistance zone, then that resistance zone is also additional confluence to that resistance zone, showing that that zone there is highly probable, in which market will surely respect that zone. Not because I'm saying the market will respect it, that means you should go and put your pending order at this point here and your stop loss at this point here, then start catching the sell. No, that's not how we enter. We have our entry model in which I'm going to be showing you guys shortly. Now, let's on our EMA to see what the market is showing. If the EMA is above, showing that the market is bearish, yeah. Now you can see that the EMA is also above, showing closer to this. Now for you to see that, yeah, this is a highly probable resistance zone. So we're waiting for a pullback to this point. Likely tomorrow, market may likely come to this point, or maybe today, depending. But whenever it comes to this place here, we're going to be taking our advantage of this trade down. We're going to be catching it down. We are going to be selling it. We are going to be shorting this trade down here. Now you can see the highly probable point in which this trade is likely going for a bearish move. Are you seeing how all pairs are in sync? Very simple, easy, and straightforward. Clean, nothing too much, nothing that hard. Simple. Now we're going to be taking off all these things so that our chart can look neat, so that we won't have anything such as analysis paralysis. Now you can see now that this is looking clear and clean. Since we have seen this now, what are we going to be looking for? We're going to be going to our 4-hour time frame. Our 4-hour time frame is mainly used for entry. I use 4-hour time frame for entry depending on what I see, but 4-hour time frame gives me high confidence on selling or buying the assets that I'm seeing. Now I'm going to be going to the 4-hour time frame. Now on the 4-hour time frame, what can I see? I could see that the market is pulling back to that resistance zone. So whenever this market should come to this resistance zone, I'm going to be catching it. At this moment now, this pair is not in my watch list. I've put a pending and a clock or an alarm. An alert, yes, that's what it is. I've put an alert at this point here. Where's that alert? Okay. Let me put an alert at that point here. Just give me a sec. So I've placed my alerts at this point here. So when market should come to that point there, I'm going to be notified immediately. So far I'm connected to the internet. I'm going to be notified immediately so that I can come back to reanalyze this pair again for either I enter or I sell. Now on the 4-hour time frame, let's see if the EME is also corresponding closer to that resistance zone, because I'm a man of confluences. We have first of all used Fibonacci. We have first of all done our third analysis. We have first of all look for structure, the directional bias, that is top-down analysis. Now you can see now the EMA also corresponds to that one to highly probable point. Now we are going to sit now and wait to see what the market to do. If the market should do something like this, should pull further, because I'm expecting this market to create something like this. I don't like market that just dive. I don't like market that just dive like this, come back like this. I prefer a match, something similar pullback, matured pullback, the pullback like this, showing us that the market did not just, that the market suffered before going, yes, before pulling back to this point. That's what I like seeing. If I should see something like this here, I have an entry strategy for it. But if the market should just go like this, straight to this point here, then I also have another entry strategy for it, in which I'm going to be explaining it in detail in my next video. So this is what I'm expecting on GBPNZD. So you see how simple I explained this, and I broke down this pair in less than how many minutes. So that is how I usually take my trade. I usually take my trade on a daily basis, depending on the setup I'm seeing, and the rest. Now, to explain a lot of things for all of you watching this video, Forex is not just all about strategy, it's all about psychology. I graded it in this aspect: 70% psychology, 20% strategy, and let me at this point, like at this point like this, 60% psychology, 20% risk management, and 20% strategy. Now, if you think that it is only strategy that you need to be successful, you are wrong. That means you are just coming into this game as a newbie. Forex is not all about just strategy. There is more into it, and it's broken down into different parts, and each of them you must also generate an edge in each of them. Meaning that if you have an edge in the market, meaning that if you know how to analyze the market very, very well, and you know that the market always respects your analysis, then you have an edge, knowing that anytime you analyze the market will respect it. But that does not mean that because you know how to analyze the market, you will be able to make money out of the market. That is two different things. Now that is one. Once you have an edge in technical analysis, that is one. You need to have an edge in risk management. An edge in risk management, so that an edge in risk management means that whenever you take trade, because this is a game of probability, you may be able to lose one, and the next time you take another trade, you know that yes, you'll be able to make times 2 or times 3 of what you have lost, so that you can be able to cover up, making your account so that you will not be able to blow your account, so that you still have lives to continue to be consistent in this game. That is risk edge. Then another one again, which means psychological edge. This is the hardest part of it all, in which is being graded 60%. Psychological part of this game is the biggest part, meaning that you can be able to analyze the market, everything, do your top-down analysis, this and that, blah blah blah. But you may, for example, now your family members, this and that, school, this and that, you may just be psychologically down, and you now say you want to trade. If the market should just give a little pullback, maybe on a drawdown, your mind will start beating, because your mind is not clear. Your mind is not clear, or you may start doing your analysis over again after you've clicked the button, in which is not right. So psychology aspect is the biggest part of it all. So if you want to learn all this, please make sure you send me a DM, or you click on my Telegram link. I'm going to be sending it on the description part there. Send me a message there, and I'm going to be explaining everything in details for you. And I promise you, by God's grace and your commitment to it, you'll be profitable. So if you like this video, if you like how I teach, please make sure you subscribe. Make sure you like, because all this thing you're going to do to it is to help the algorithm, the YouTube algorithm, so that my videos can be able to reach others that are also suffering, are also having questions, and maybe this video can be able to answer their question. Please make sure you follow my channel back to back. Have a nice day, and I wish you all the best. Happy new month.